Hi everyone, this is the Money Show. I'm with you, Kavita Thapliyal, and money affects every part of our lives, how we live, what we dream, and the choices we make for our future. Yet, for something so important, personal finance is often the best and the least, in fact, talked about and the most misunderstood. Whether you are earning your first paycheck, managing a household, or planning for retirement, one thing is certain, it's not about how much you earn, but how well you manage what you have. So today, as always, we are here to simplify money matters, to break down the concepts of saving, investing, budgeting, and building financial security into something practical, relatable, and actionable. Because financial freedom isn't a privilege reserved for a few, it's a journey that all of us can begin with one smart decision. In fact, one smart decision at a time. So let's get started on taking control of our money instead of letting it control us. And we will start with, making sense out of the market trajectory and what's in store for your portfolio. Rahul Jain joins us from Nuvama. Rahul, hi. Welcome to the show.
Hi, Kavita. Thanks for inviting me to the show.
Very interesting times and definitely a lot of hand-holding needed from you for our viewers. So, Rahul, let me just begin with a very simple question. Where does Nifty actually stands in terms of valuation? Because we know we cannot sugarcoat. In fact, sugarcoating the near-term pain is definitely not something that we can do. Earnings growth will likely stay in single digits for another year. Supply chains are under stress. Oil prices will probably settle well above pre-war levels even after the conflict ends. But strip away the short-term noise, what remains is a market that has corrected to its long-term average valuations, with a domestic growth engine that most economies in the world simply do not have. So, Rahul, after a long time, we are 6 years into this bull market now, if we can count on that, we are seeing value emerge in a lot of high-quality companies. I want to understand your sense of the market trajectory right now and how are we placed in terms of value and valuations, Rahul?
So, Kavita, as a wealth manager, my responsibility is always not to sugarcoat and to give the right perspective. And I'll try doing the same again here as well. So, from your question, where you think market trajectory, etc. So, we at Nuvama are now fairly comfortable with the equity markets, and we think from here on, it looks a good market to invest upon. Not from putting everything at one shot, but over next 12 months in a staggered manner would be a good point. Coming back to your point of valuation, I would say that if you look at from market point of view, valuation is important. Second is the intensity of selling, which is whether through FIs, DIs, HNI investors, retail investors, because that also adds to the pressure. And third is the whole geopolitical thing which is happening with us. So now, talking on valuations, I think market has reasonably corrected from valuation point of view. If you look at FY28 earnings, because in next 10-15 days, you will move to FY27, so people will start looking at FY28. So FY28 Nifty earnings should be around 1400, which at 23,000 Nifty is around 16.5 of a price to earning. Our median price to earning is around 20. So you find a decent valuation correction available on your median price to earning. This from large cap Nifty. But if you look at mid cap, small cap also, I think the froth which was there from valuation point of view has got corrected. So from valuation point of view, market is in a reasonable place, I would say that. From intensity point of view, if you look at March, the current month, FIs have sold the highest ever in a particular month. So my sense is that intensity should also now sober up and should go down. That will be the other important part. And third, from geopolitical, I think, who knows better than you, it's very dynamic. But yes, there's some sort of positive news emerging out of it. It might change over the next 3-4 days, a couple of weeks' time.
Right.
But from valuation point of view, it gives a lot of comfort. And from equity market standpoint of view, it is always good, Kavita, that when everyone is very fearful, you should start investing. And I think current situation is very similar to that.
Absolutely, absolutely. So, I just want to understand the scenario. India against the world. So, what makes this sell-off different from past crashes is how isolated India looks on the global map, Rahul. Beyond the tech gap, India is dealing with a set of pressures on their own, that have compounded on each other. Rising imports of crude oil, gold, electronic components have weakened the rupee over here. A weaker rupee in turn accelerates foreign selling. Every rupee that falls against the dollar makes it costly for FPIs to convert their returns back to USD. Two forces actually feed each other. In the short term, the pain is going to intensify, Rahul. That is what can we analyze from the current situation?
So I would say it will be very difficult to predict whether if the pain can intensify. I would come back to my older point that valuation now seems to be reasonable. Anything of such sort which is happening in the market right now has a global impact, and for example, India will also have a short impact, and that's why the market has also got corrected in last, I would say, 15 days, or if you look at from 1 week's time. And if you look at from now, there was a lot of conversation where the valuations are higher from India point of view. I think those have got corrected, which creates a lot of comfort from investing point of view. Can this intensify? Yes. If this geopolitical gets more nasty, it can intensify. But whether it should be used as an opportunity to buy, I would say if an investor is starting or wants to do staggered, it might be a good point of starting it.
Rahul, because you are in the wealth management business, I want to get a sense of ground zero. Now, when you are going and talking to clients, so what kind of changes do they want in their entire investment strategies? How are they looking at these market dips and the war situation?
So obviously, I would say that right now there is some sort of, I would say, concern over the equity markets, and obviously, if you look at from equity returns from last 18 months also, I would say 24 months also, the returns have now almost become negligible or zero. But we come back to clients and tell them that asset allocation is the important part.
Right.
If you have the right asset allocation, I'm sure that in the current asset allocation, debt would have gone more heavier. So good time from switching from debt to equity. That is one. Good time to review your portfolios. There are laggards in your portfolio. There are things which are outperforming. So the reallocation can happen. So all these times are good to just go to the fundamental basics, evaluate that whether they are doing right or wrong. If they are right, then nothing to worry. I think then you can peacefully chill and relax. And I would say that it's a good time to just switch off from market for a couple of days. It will be a good detox.
Yeah, I think that is the best strategy, but then you can't help it when the portfolio is showing so much of red. So, where are you advising your clients to put the buck on? In what sectors? IT stocks have gone down to almost 2008 valuations now. How are we looking at sectors from your end?
So, I would say that generally we suggest clients to look at more passive investments, mutual funds, AIF, etc. Because I would say that most of our clients, their full-time job is not into investing stocks. And we also believe that all these calls should be taken by the fund managers. So that makes life easier for clients. But nevertheless, I think from sectors point of view also, if you ask Kavita, I think the Indian consumption story sectors will look good. Defense looks good, seeing the current situation. Private banks also now looks reasonable priced. So these are three sectors which people should look out for. But we generally advise clients to look at right mutual fund schemes, become more passive, because the fund manager, I believe, would have far better EQ, emotional quotient, to handle these type of situations.
Definitely. For a lot of people, or in fact, if I just want to get a sense of retail investors and their strategy, see, as far as AMFI numbers that we are seeing month on month, there has been change within equity and market caps numbers, but SIP is still on record high almost every month. But now the data remains very crucial for the upcoming months because we have seen the pain sliding in over there also. But having said that, if within equity one wants to, reshuffle or revamp, because this is the time where you might want to do it, overall diversification and asset allocation strategy also needs to change because we are looking at almost all the asset classes, Rahul, behaving very differently. Gold and silver being safer havens are not exactly, I mean, yes, definitely there has been considerable run up, but right now they are not behaving the way they are meant to. There are different fundamental triggers and the reaction on asset classes. Within equity, one wants to really go heavy. Is the large cap the place where you should be putting most of your money?
So from equity standpoint of view, yes, large cap looks have a better valuation comfort for sure, and a good sum of money should go there. But some parts now should start coming into mid cap also
Okay.
because there also the froth has gone away from valuation point of view.
Mm-hmm.
And effectively, if anyways your thinking is staggered
Mm-hmm.
and you can never time the market to the T, that is
Mm-hmm.
always also very, very sure thing. So a good amount of allocation going to large cap, then some part to Nifty and very small part to small cap is the way to look at it.
Mm-hmm.
And in couple of months, you can redecide whether how things panning out, and then you can start reallocating more to mid caps if you're finding growth, etc., coming in that part of the world as well.
Mm-hmm.
So that is how I think about from equity standpoint of view.
Mm-hmm.
Uh, Gold, I would say, has got corrected in last week's time.
Mm-hmm.
Otherwise, it was running fairly steady. But if you look at gold returns, Kavita, from last 12 months, 24 months, or a 5 year, the CAGR are brilliant. Like gold has delivered 64% in Indian terms in last 12 months,
Mm-hmm.
a 40% CAGR in or more than 47% in last 2 years from Indian rupee term point of view.
Mm-hmm.
So some correction here and there will happen for sure.
Mm-hmm.
But generally, gold will do well when most of the things will not do well in gold.
Mm-hmm. Mm-hmm. Right. Let's talk about the oil shock. I think this is the headline. I want to understand, is the oil shock in your entire analysis priced in or not? Also two key monitorables for investors navigating this environment is Brent crude prices and the rupee dollar rate. How would you like to explain this, and how is all your analysis right now that we're talking about has factored all of this in?
So I would say that if you see the overall correction in Nifty,
Mm-hmm.
anyways, what happened in last 15, I would say, since this whole Iran thing started happening,
Mm-hmm.
was anyways not warranted. If this would have not happened, the Nifty would, I personally believe, would have not got corrected.
Mm-hmm.
But this has all happened because the market discounts what can be the outcomes of things like an Iran war or some other geopolitical situation. And oil has been the important constituent on that.
Mm-hmm.
It will be very difficult to tell that the full discounting has happened or not. But obviously, a large part of shock has been absorbed. Now, if oil goes to $200, for example, from Brent point of view, then can you have more deeper cuts? 100% you will have more deeper cuts. Then you're also saying that the geopolitical situation will seriously go out of hand.
Mm-hmm.
And I would say then that will be very difficult to predict. But otherwise, I think to make it more simpler, at least how I look at it, is that look at the Nifty valuations. And if you are generally a mindful investor, you will do asset allocation, you will invest over a period of time, then I would say a P earning of Nifty is a good indicator to look at it. The more variables you keep adding, your thesis of investment becomes more complex. And as an investor, I would avoid adding too many complexities in my thesis.
Mm-hmm. All right. What's the status of your personal portfolio?
So I am a big believer in asset allocation,
Mm-hmm.
and I have been So for me also, what we have been advising to clients, I've been doing personally, look at asset allocation and also things which are not doing well in your portfolio. Good time to get rid of them. And because you're getting a lot of decent stuff right now from equity point of view. So some change here and then from reversal point of view from debt to equity is a good idea. And maintain a good allocation for gold and silver. So I'm also some little bit investment in silver as well.
All right, interesting. I think with that, it's time up on the discussion also. But the message is very clear. The message is not to panic and exit. It is to be patient, deploy capital in small tranches, and resist the urge to call the bottom. For long-term investors with the stomach to hold through the noise, the current environment, painful definitely, but is precisely where the foundation of the next rally gets built and your portfolio shows maximum returns. With that, thank you so much, Rahul, for being on the show and helping our viewers.
Thanks, Kavita, for inviting me to the show.
It's time for a short break. Be right back.